So, with our team, as you're aware, we don't just look at investing on its own. So a big part of being with a practice such as ours is you get access to managing from a wealth perspective, not only your money, but the risk you're taking on, taxes, debt. We do the full gambit. Members of the team that are with us today, myself, Aaron, John, and Ryan, these are the 4 lead advisors on the team that you would deal with. And then behind the scenes, of course, we have, just as or more important, our portfolio management team, which is Zaw and Elvis Picardo, as well as our associate advisors, Aaron Cooper and Zaw, working as an associate as well. And then, of course, our CSA team, not to be missed, which everybody's fully aware of. So today on the webinar, we're going to have the 4 of us, with myself speaking, Aaron, John, and Ryan, all there to answer your questions. And this is the legal stuff. Basically says I can't be held liable for anything I tell you today. No, just kidding. So when we're thinking about the course, and we're thinking about, an overall look at your finances, we've got the investment part, risk management, which is generally considered like what happens when the wheels fall off. So that would be the insurance component or estate planning component. Tax, which is obviously the big bugbear in the room when it comes to your finances, and debt and cash flow management. So today, as part of the process of financial planning, we're really going to be looking at step 3. So normally, as you know, this should really be, if I could make prettier PowerPoints, would be circular, because it's a never-ending picture for you. But it's identifying your goals. We always tell our clients that the most important thing when you're sitting down with your financial plan and your coach, one of us, is to prioritize and figure out what's important to you and your family. What am I trying to achieve? What are my goals? Then we figure out the facts and figures of where you are. So this would be your assets, your liabilities, your cash flow. This, for some people, can be like pulling teeth, because quite often it's the first time they've had to go through this. This is, looking at exactly where everything is. Then it's figuring out where the shortfalls are and analyzing that data. So that might be on the portfolio management side. It might be on the cash flow side. We then obviously would come up with a set of recommendations, implement those recommendations, and regularly review it. When I'm asked about how often people should do their reviews, I would say a comprehensive review going through steps 1 to 6 would be extremely necessary, at least annually, or when there's a fundamental change in your needs or your situation, job loss, retirement, moving, debt, like any of those major things would mean that you don't want to go through from step 1 to 6 again. We tell our clients generally to do that at least annually, or as the situation warrants. So today, as I said, we're going to focus on step 3, which is the analytics of specifically looking at your investment accounts, so all the money that you saved up, and figuring out how to understand volatility when you're setting up the cash flows. So what do I mean by that? Well, let's just take a little quote from Henry Ford first to start out there. There's no big problems. There's just a lot of little problems. And we know that when those little problems pile up together, they quite often become a big problem, the proverbial straw that breaks the camel's back. So some of the problems that we see with portfolio management posed to us by our clients, and that we see in general when we're doing financial planning, is number 1, running out of money. Big problem. So as I say, you don't want to run out of money before you run out of life. That's a bad situation. Panic. So human beings are very emotional creatures. This is what makes the majority of people very poor investors. And by that, we mean panicking based on short-term variability. You're set up to fail quite often in this business. And part of that is the amount of constant bombardment of information, too much for the human brain to handle. And then we react. When we have too much information to deal with, humans tend to react emotionally. So we'll talk about that a bit. And the key is, when you're reacting, is the problem would be to change your strategy. So I'm right in the middle of an emotional reaction, and I'm going to change the strategy that was supposed to get me through this in the middle of that time. We've definitely been tested by that in the last 18 months. going back to COVID, we'll look at that. Okay, so let's start with talking about cash. Okay, so now hopefully these numbers are showing up okay on your screen. I did my best to make that as big as possible, maybe make it as big as possible on your screen. But what am I showing you here? Well, you can go to, and this is the most up-to-date one from June 16th. I've highlighted the May 19th one, but you can go to the Bank of Canada and get rates on everything. And you can get those rates historically on mortgages, on prime. So what I've pulled is the weekly Wednesdays, they call it. So this is the last one being June 16th. And what you can see is the prime rate. In other words, the best rate you're going to get from a lender right now is 2.45%. Interesting thing is the conventional mortgage on a 1 and a 5 year, so you go back and you want to borrow on a longer term on a mortgage, you're probably going to get between 2.79 and 4.79%. Now that's posted averages. So as we know, quite often the lenders will have their actual rate that they'll lend at. But prime's at 2.45, 5-year debt's about 4.7, closer to 3. You can negotiate or less on a mortgage. Now remember, these would be fixed rate mortgage, not variable. Now look at deposits. You put your money in the bank, you're going to get a 5-year GIC at 100 basis points, 1%. Okay, daily interest savings, this one's funny. This is over $100,000. That's not a typo. The average is 0.01%. We recently had a client with substantial amount of capital come over. It was getting, and we're talking in the millions, 0.2%. So you're basically getting nothing on cash, and you're paying 2 to 3% on 5-year debt. Okay, so here's what you have to understand about cash. Cash is for saving. It's not an investment. The real return is zero. Okay, the real return is zero. You say, well, Robert, you just showed me that the return was 0.01, but the real return is zero. We'll talk about that more. Now, there's no risk in the short term. Now, let's define risk. Risk in the sense that you won't or can't lose all your money, and there will be no variability in the return on your money. So your statement will say $100,000 plus 1/12 of 0.01% the next month. So not very much. So what's the risk with cash? Well, risk with cash is, as we've seen recently, because it's been all over the media and people tend not to really talk about it a lot historically, but is inflation. What's inflation? So the gradual, or sometimes not so gradual, increase in the cost of goods and services. So things get more expensive, but you're sitting around with a bucket of money doing nothing. Okay? So what's going on here? What's been happening? Well, the biggest market in the world is the debt market, not the equity markets. And the debt markets tend to move very rapidly to reset when there's expectations of inflation. And the first thing that will happen is you'll see yields jump on longer term debt. And this is where banks get their financing for mortgages. So if you look at the red line there, that's the Government of Canada bond average yield over the past 10 years. And you saw that it was approximately 1% near the end of 2019 and spiked to over 2.3%, and then has settled back a little bit lower. But what you can see there is that yields, yes, they may have jumped compared to historic or short-term low yields, but historically, if you go back to, say, 2010, the average yield on a 10-year Government of Canada bond was 4%. So now it, vacillating between 1.5, 1.6, that those yields have come down a lot. Interest rates have come down a lot. Now they're rapidly increasing. People quite often misconstrue the idea of short-term interest rates that they see posted in a bank like Prime with the bond market, which is actually where the interest rates are set. So the bond market's saying to you here, we think there's going to be inflation. So pausing there for a second, test question number 1. I'm going to start a poll. Now everybody goes into the poll and you can answer, and I'll have the results of the poll live. Okay, so let's do our first poll, shall we? What do you think the real return on cash in the bank will be over the next 5 years? Do you think it will be more than 2%? Do you think it will be nothing? Do you think it will be negative? So if you have cash in the bank, GIC, high interest savings account, what do you think your real return is going to be on that money over the next 5 years? Keeping in mind what the bond market's telling you about inflation. We have a very smart group of people in this room. So I like how the little bar moves as everybody answers. So 60%, give or take, now we're at 57, 58, we're back above 60. Give people a couple more minutes to answer. Zero's coming up. Okay. It seems to me that, at least 94% of the people believe that cash will make them nothing or cause them to lose money over the next 5 years. Now, the interesting thing about that question is the real rate of return. So as you know, the real rate of return has to include tax and inflation. Okay, so the key about that question is, what am I getting after I take off tax? And what am I getting after I take off inflation? If you look at the lower end of that slide, you would have to make 4.2%, 4.28 to be exact, percent interest minus the average tax rate on people's interest income. It's taxed the same marginal tax rate as salaries or rents, other as they call it. So 4.28% interest minus 30% tax minus 3%, which is the current expectation of inflation, gives you zero. So what this also tells you is the tax rate is probably going to be around the same on that middle tax bracket, 30%, but that inflation number could increase. So for most people, the real return on cash in the bank over the next 5 years is either going to be zero or negative. And unless that cash, which I don't think you can find, you definitely can't find a 30-year bond or a 10-year bond yielding over 4.28%, and you certainly can't find a high interest savings account or a GIC. This is an interesting chart. So I've taken 3 asset classes. Commercial real estate, which is blue line, so that would include all real estate investment trusts and includes everything that's not residential real estate. Gold and cash, 3 kind of real assets, and looked at their effects, inflation adjusted over since 1994. And if you look at cash, you can see that there's hardly ever a period of time where cash gives you a positive return. So what is cash for? A real positive return. Cash is for safety. Okay, cash is that part of your portfolio that is there to protect the money. Okay, so if you're trying to beat inflation, what you have to think about is owning assets. And those assets could be anything from bonds, real estate, portfolio assets, including, infrastructure, non-correlating assets like mortgages, equities, in other words, shares of companies. But the cash in your portfolio should be there as part of your financial plan for money that you need in the short term. Because the only way you're going to fight inflation over the longer term is to own things that will go up in spite of inflation. Okay? So if you look at, for example, the equity markets, so the yellow line there being US stocks compared to cash and bonds, bonds offer some degree of inflation protection because they tend to pay higher interest rates than cash with very little variability on the returns. But clearly, owners beat lenders. So what do I mean by that? Well, if you're a bondholder, you're generally lending money to someone, be it a corporation or a sovereign country or a municipality. If you're an equity owner, you're owning shares of a company. And this just makes sense. This is capitalism, right? You borrow money to make more money. You're taking the risk on. You're making your widgets. You get variability in your returns. Some businesses do well, some don't. But overall, if we have a large basket of companies, capitalism beats inflation, cash, and bonds over the long period of time. So here's the problem. Everybody knows that. Oh, the long-term stocks win. Okay, but the real world doesn't look like that. There's no 7% flat line every year return in the equity markets. You get these gyrations. So what I've shown here is the annualized rolling 3-year return of the equity markets, cash and bonds. Now, what do I mean by that? So if you you took that specific date in time, what was your previous 36-month average rolling return? So you can see there's periods of time, you see the zero on the far left, there's periods of time where your 3-year average return in the equity markets would be negative. That makes sense. If you invested in 2000, it took you to almost 2004 to be positive again, right? So that was the first time we had the dot-com bubble burst. If you invested in 2008, it took you till almost 2012 to come back to parity again. So there will be bouts of time, and there can be longer periods like the 2000 to 2004, 2008 to 2012, where you get your average return in the equity markets is negative for that period of time. So major periods of dislocation. We had a very big V occur during COVID, with the markets gyrating massively. The peak to trough in February, March of 2020 was tantamount to, it took 3 years for the equity markets to drop 45% during the dot-com bubble. So this is why you need some balance. So if I sit there in cash, my rolling returns are never negative, but the actual return I make is rarely positive. If I'm 100% stocks, then I have this issue of getting whipped around and gyrating, and that's not a good feeling during retirement. So let's look at this. The facts are that in order to ensure a positive return on a portfolio, you have to hold an investment with at least a 3-year time horizon. Does that mean you have to hold the investment for 3 years? No, it just means when I put my dollar into this thing, I should have the expectation that I don't require that entire dollar back over the next 3 years. Why? Because I could put it in tomorrow and next month it might be worth 90 cents. But if I wait and I give that asset time to come back, it will do quite well for me. Think of housing. So the traditional reason many people do well in their housing is the time horizon over which they hold it, right? You're not generally flipping your house every 6 months. And if you hold your house for a longer period of time, after you've started to pay down the debt on that house and you've given it time to grow and go through a number of economic cycles, you'll get a positive return. You will always get a positive return in cash. So what I tell people is, if you're actually going to be an investor, any parts of your financial plan that are for investment, always be an investor as if tomorrow is going to be the start of 2008. So if I invested all my money tomorrow in my portfolio and the next day 2008 occurred, how long would it take me to get my dollar back to $1? So if you look back here and you invested in January 2008, for every $10,000 you put in the equity market, it dropped to, approximately $5,000. So you lost 50% of your money by January 2009. And it took you all the way until, almost July of 2011 to get back. So if you require all your capital to be liquid without any potential for a negative return within the next 3 years, you should be in cash. You're actually not holding an asset. You wouldn't buy a condo, for example, with the expectation I'm buying it today with all those transaction costs and I'm going to sell it next year and I think I'm going to make money. You could make money, but you likely will not. And the same thing holds for financial assets. Now, remembering that if you hold cash, your return after inflation will be negative, right? If I took $1 today and I buried it in my backyard and I dug it up in 5 years, my dollar will not buy as much. Okay. No matter what StatsCan tries to tell you about changing their inflationary basket of goods or removing things from inflation that are volatile, like food or energy, we know that dollar loses buying power on a regular basis. And it has become even more so a contagion now with all the cheap money floating around. The good thing with cash is if I have $100,000 in a high interest savings account today and I open it up 6 months from now, it is always going to have a nominal number of $100,000 or more. The real return will probably be negative. Okay? If it was different this time and the markets, for example, don't recover and go to zero after something big like that, please go to uncrate.com and buy your zero kit. So the zero kit will prepare you for the inevitable zombie apocalypse. Now, why do I jest and put up a slide like this? This is an updated slide from some of the previous zombie apocalypse preparedness kits you might see. It's because it's never different. What do you think happens to people at the bottom of an 08 cycle or at the bottom of March of 2020? People believe that it will be different this time, right? And that the equity markets somehow will not recover. Ask yourself what that means. If we've got something like in the United States, the index that tracks the top 500 companies. So you think of all these companies that make up capitalism and the biggest 500 of them you can think about. What do you think the odds of all those companies going to zero are? It's likely zero. And if it's not close to zero, if for some reason we wake up tomorrow and every company in the world is worthless, I hope I have my zero kit because I'll need a bunker and merit and most of these devices to keep me safe. So given that all you're really looking at when you're truly an investor and not a speculator, you're looking at price variance. And what do I mean by that? Speculators go on Reddit boards and buy things like GameStop. Speculators buy Dogecoin. Speculators get their advice from a mass media source. Investors own good companies with free cash flow that pay dividends and make money. So let's not confuse the speculator with the investor. I don't talk about speculation. We don't do that kind of investing for people. That's for people that have no money, that want to have a lot of money in the short term. And usually what happens to them, they lose all their money. I say it'd be more fun for you just to go to Vegas. So the chances of you needing your zero kit are hopefully also near zero. Here is a truly diversified portfolio. This is what we call our pension portfolio. This is our biggest bucket of all the money we manage, and we manage now over $500 million. This portfolio is meant to mimic a defined benefit pension plan. So as many of you have a defined benefit, many of you don't. But if you don't, and you have our pension portfolio, what you essentially have is, just like mom would tell you, don't put all your eggs in one basket. That's what this portfolio does for you. So instead of just having stocks and bonds, we have everything from diversified kinds of bonds, real estate, mortgages, infrastructure, specific kinds of inflation protected bonds like floating rate. And without getting too much into the weeds here, this is the idea of having a diversified basket for yourself. Okay, so this is what we would call our balanced portfolio. Sometimes you'll hear the balanced portfolio referred to as a 60-40. So 60% of it's for growth, 40% income. In the past, when I started, it was 60% stocks, 40% bonds. But we don't have a 40% bond component. We'll say a 40% income component, because you don't want to just hold bonds, because when interest rates go up, bond prices go down. So we have things like mortgages, preferred shares, infrastructure, utilities, floating rate debt, corporate debt, bonds, Canadian real estate. So all of these in your portfolio, in addition to the stock component, and that 60% that's in equities is generally broken down to 1/3 US, 1/3 Canadian, 1/3 international. And we vacillate a little bit within that 60. Most people's balanced growth investment policy will tell them that their target is 55% stocks to a maximum of 65. So how do we roll this all into planning for my retirement? Well, you see the feet on the tightrope over the shark den there. Let's assume that you're investing and starting your redemption strategy, your decumulation phase of your life, just prior to a market meltdown. So right before you invest, then it goes to 2008. And what we're going to say is you're going to expect for every $100,000 that you have, that you're going to get roughly $5,000 of income. So we'll call that our 5% rule to start. And we're also going to assume that your money goes in to your long-term portfolio for the next 30, 40 years of your life, right before a major collapse in the world markets. And then you're going to regularly rebalance. We're not just going to leave it there. We're not going to go, okay, here's our money there. You've got your portfolio management team that says if stocks go down, we'll always keep you at that target of around 60% stocks. Now remember, we're going to come up with a decumulation strategy to spend your money over time. Now, not everybody wants to spend all their capital. If you're not looking at spending your capital, you would take out less capital than the 5%. So let's kind of go through this. We have here 3 potential portfolios we're going to look at. Okay, we're going to look at portfolio number 1, which is a GIC or cash only portfolio. So all my money, Robert's in a high interest savings account, or it's in GICs. And that's even my RSP, my TFSA, my investments. I don't want any variability. I don't like that. Portfolio number 2, I'm all in. I've got half my money in the United States, top 500 stocks, and the other, and 25% in Canada, 25% internationally. That's the 50 global. So that's a high growth investor, just own companies. Portfolio number 3 says, I want to be a little bit more balanced and diversified here. I'm going to have 60% in stocks and 40% for income. We'll call that a balanced growth. Okay, so here's poll question number 2. Assuming you started in 2008, right in 2008, which of those 3 portfolios do you think would have a better return over time? If I had all cash, if I had all stocks, or if I was balanced, 60-40. Remember, I'm telling you started at the worst possible time. And remember 08, it was really, really nasty time to be in the equity markets. Give you guys a couple more seconds. No, nobody's thinking cash won, huh? Remember, this is a collapse. Can't get anybody to click number 2. All cash, going once, going twice. Oh, some people are saying stocks. Oh, it's shifting. It's shifting. People are, can you change your answers with this? I don't know. Okay, so assuming you started in 2008, which of these 3 would have done better? So if you had a $250,000 portfolio in January 2008, you didn't make any withdrawals, your $250,000 all stock portfolio today would be worth $581,439. Even starting at the worst possible time, your compound average growth rate per year would have averaged 6.5%, 6.58. However, your drawdown, your 250 dropped as low as 125, 50% drawdown. Now, if you had cash, your 250 grand today in rolling GICs would be worth 270,000. Compound average growth rate of 0.58%. But look, I never lost any money. Yeah, but last year you made 0.02%. The best you did was in 08 and 09 when GICs were paying you 2%. Okay. But look at the 60-40 portfolio. So it ended up slightly less, 490 versus 580. So 90 grand, 80, 90 grand less. Average return of 5.25 versus 6.5. But look at the variance annually. The worst year you would have had would be a drop of 24 versus 40. Now ask yourself this. How many people would have not done anything differently had their equity portfolio gone from 250 grand a year later to 125? We know many people would have done something differently because what happens is when the markets are at their peak, the volume increases on the buy side. When the markets are at their bottom and there's capitulation, the selling goes up like crazy. The antithesis of what any kid can tell you and parrot to you, that you should buy low and sell high. Now, the key with a lot of you is you realize that even if you started at the worst possible time, in the accumulation stage, if I buy and hold, I can, for lack of a cliche, the old saying, prosper. Now, this is during accumulation. And I used to say any monkey can manage your money in the accumulation stage, right? Because as long as you're not selling and you're closing your eyes and plugging your nose and you're putting more money in, yeah, I can have that equity portfolio. What happens when I get to the stage now where I'm not putting any money in, I'm taking it out? Well, now that variance becomes your chief enemy. So let's look at that in more detail. Let's start another poll. If you started drawing income in the year 2000 Okay, so right before the dot-com bubble burst, so 21 years ago, which asset mix do you think provided the best long-term return over the past 21 years? So let me say that one again. If you started taking income, so you retired 21 years ago, and you had three asset mixes you could have chose, balanced, all stock, or just cash, which do you think would have fared the best? And we looked at what happened. Even if you invested at the worst time in the market, stocks would have done better. So why don't I just have an all stock portfolio all the time? I make an average return, Robert, of 6.5%. That's considerably more than the 5.25% I'm going to make on the boring balanced portfolio. This group cannot be swayed, or they've actually stopped answering the questions in the poll. But look, you know, my slide, I show you final balance. If I grow, I just hold stocks forever, right? No? Okay, so nobody's taking the bait here. 94% of you are saying, no, there's a couple of people saying, oh, I'm just going to hold cash. The interesting thing in decumulation is cash and all stocks. If you happen to start the worst period of time in the equity markets, if you are unlucky enough to get variation that's negative at the beginning, you will run out of money with a 100% equity portfolio. So look at this, $100,000, for every $100,000, this person started taking out 5% a year in an all stock portfolio. They got bad returns at the beginning. They were just unlucky. They retired right before the dot-com crisis. So they retired right at the beginning of 2008. In this case, right before the dot-com crisis, this person ran out of money with a 5% withdrawal rate by 2018. Cash person wasn't far behind, which makes sense. You take out 5% of the portfolio plus inflation and you're making 2 or less, you're spending capital. But look at the balanced portfolio. Even an easy balanced portfolio, 60 stocks, 40 bonds, okay, still has considerable money left in the portfolio after 18 years. And in this case, you know, over 30% of the portfolio is still remaining. Okay, so what we have to realize is this strategy of a balanced portfolio is there for a reason. This is what all major pension plans, the CPP, BCIMC, Quebec's pension plan, this is the asset mix that they will follow. So let me do the next question then. Don't worry, there's not going to be too many more of these. So knowing that I have a 60-40 balanced portfolio, and this is good during my decumulation, I don't want to have all cash or all stocks. If I looked at a 10-year period then, how many of those 10 years do you think would be negative if I have 60% stocks? So you're showing me here, Robert, 18 years. I can see the portfolio is going up and down, but still doing way better. I'm averaging 5.25%. I'm happy. I'm not going to run out of money. But annually, what are my chances of running out of money? Out of 10. Every 10 years it goes by. How many of those years, if I took every one of my statements and I just didn't look at it and I threw it in a drawer, and at the end of the year I just looked at my, my year-end balance. I said, did I make money or lose money? How many of those years do you think I lose money? So nobody thinks I'm going to lose money 70% of the time. 82% of you think I'm going to lose money 30% of the time for you. And 20 people think, no, not going to be negative on an annual basis. I make money on that portfolio no matter what, every year. Okay, so what I've done is I've gone back from 2008 to now and shown you 3 portfolios, right? So you got cash, 100% stock, or 60-40 balanced. And then the years on the left, and then the return is in the middle of each of those. And the red is obviously bad. So you see something here. If you go back to 2008, the 100% stock portfolio was down 40.57%. A 60-40 was down 24. 100% stock dropped 6.88 in 2011. Balanced portfolio 2.5. 2015, another bad year. Stocks were down 2. Balanced portfolio down 1.46. 2018, stocks, it was another bad year. Stocks were down 10. Balanced portfolio down 7. See, any year the stock market's negative, your balanced portfolio will be negative because 60% of it's in equities. So your chances of being negative on an annual basis is roughly 30% of the time. That is what you have to put up with being an equity investor. If you want to average 5.25+%, you have to be willing to have these negative years. If you're not willing, it's column number 1, which is a loss of money over time. Okay, so you see that you will, in so far in 2021, the inflation, 0.98, and the return on your cash is 0.02. Last year, inflation 1.36. Remember, these are posted inflation numbers. You and I both know that inflation, is probably considerably more than Stats Canada is presenting. But, ask yourself this: if I can put up with a little bit of variation and significantly less variation than just an all equity portfolio, then it's, again, reiteration that asset mix on the third column is the one we should go with. Okay, so you seem to have that one, pretty nailed down. Last question. Let's say you retired at 60 in 1991 with $250,000, and you took out $1,000 a month, every month, and you indexed it to inflation. Okay, so you're 90 now. Assuming you did follow this and you said, yeah, 60-40 balanced portfolio, rebalance me to my investment policy on a regular basis, give me my $2,000 or $1,000 a month. How much money do you think you have left by the time you're 90? This is a real world example. You started in 1991, you're 60, and then you went to 90. So actually drawing the money in real world numbers, none of this my average return, the actual numbers that we saw. So would I have more than 250,000? Around 250,000? Way less than 250,000? Or I had nothing? I burned through it. Taking $1,000 a month and I index it every year to whatever inflation was. This was a harder one. That's the last question. So we're a little bit divided. 40% looks equal between people saying I got a little bit more than 250 or around 250. A third of you, we're a third. Good. It's a harder question. And this is why this proves we understand the accumulation period, but the decumulation is a little bit of a mystery to us. How much money can I take? Depending on what I'm invested in. So let's go through this with the 60-40 portfolio. Okay, while the last of you enter your. So here's $250,000 portfolio, $1,000 a month withdrawal, indexing it to inflation every year, 30 years of just a plain old 60-40 portfolio, third US, Canada, international, and 40% in bonds. Inflation adjusted, you would still have $241,000. That's going through the dot-com bubble, that's going through 08, that's going through COVID, that's going through September 11th, that's going through 2018. The inflation-adjusted portfolio value would still be $241,000. That $12,000 a year is about a 5% withdrawal rate on $250,000, 4.8%. So assuming you're 60 at retirement, you'd be 90 years of age. So how do we wrap this together to give us an idea of how much we can take out? We understand that we need this balanced portfolio. We understand the variance we have to subject ourselves to. I have to understand that if I'm going to be a retiree or I'm going to retire and start drawing capital, I have to understand that to get that targeted return of 5.25% average, a third of the time I'm going to lose money on an annual basis, but I'm only going to go down half as much as the market. So if the stock market's dropped 10%, I'm in a balanced portfolio. I'm going to say I did a really good job. I'm only going to be down 5%, and I can keep withdrawing my money. Remember, this person didn't stop withdrawing money in 2000 to 2004 or 2008 to 2012. In fact, they indexed it to inflation. So how do we come up with realistic withdrawal rates for your portfolio during your retirement? One of the things to do is to look at what a major pension plan does. And pension plans will set maximum and minimum targets. These rates are written into law and have to be abided by. So if you have a defined benefit pension, quite often, and if there's a spouse involved, they will pay out about 5.2% of the capital that's invested behind the scenes in that pension plan. But say you have a life income fund. You will have to abide by the Pension Act rules, which set maximums and minimums for your withdrawal rates. So for example, a 60-year-old with $100,000 in a LIF, a life income fund, could take a maximum amount up in the top right corner of 6.85%. Okay? The minimum that would be suggested for that pension would be 3.3. So somewhere between 3.3 and 6.85%. So if you're in a 30% tax bracket, you take out $5,000, you pay $1,500 to the government, and you're left with after tax about $3,500. So think about it this way: for every $100,000 you've got invested, you should be easily able to give yourself $300 a month after tax. Okay, after tax. Or another way, you've got $1 million portfolio. That's $50,000 a year pension. Pension plans will use 3 to 6% of the annual year-end balance and increase that over time. So you look at age 61 here. If the start of year capital, assuming this person's only making a 5.25% return, they're taking out 5%, they're indexing it every year by 3. So you can see the pre-tax annual payout goes from $5,000 to $5,150, which is 3% for indexing. Next year it goes to $5,300 and so on. If you look, this money lasts all the way until this person's 90. But if you also look, the pre-tax annual payment's going up. So I should have a poll here that says, how many of you want more income as you get older? If we could ask you that question, you would probably suggest that, well, I don't want to run out of money when I'm older, but I would like to kind of front end load my spending. I'd prefer to have, say, slightly more money from maybe 60 to 75 and sufficient capital from 75 to 95 to make sure that I'm not penniless. Quite often when you get to the later stages, if you have a principal residence, that could always be converted and monetized and used to provide income again. But just your capital, remind yourself that the 5% rule here is working quite well. Now, what if I did want more money up front? So if I want more money up front, if I take the same assumptions, a 5.25% return, okay, but what I do is I take the maximum according to the Pension Act for another person's pension. So I just take the same table that says I could take out 6.85%, and I draw more money initially. So providing that I don't start out in a 2000 era period, if I start this maximum payout right off the bat, now I'm getting $6,800 up front, or after tax closer to $400 a month, okay? And I'm increasing it at the beginning. And as you see, it slowly decreases as I get older. The reason being I have less capital. I'm drawing a higher percentage. So, by the time you're 76, you're taking 10% of your portfolio out. However, you're taking 10% of a smaller basket because you've spent some of the capital up front. This works really well, okay, if, like I said, the year you start your decumulation is a positive year. But what if I happen to start in one of those worst years? Then I set my redemption level to a lower amount. Maybe not 3.3, but definitely not 6.85. We might go to our 5% rule. Okay, so going back here, thinking about that planning for the worst, we would change our 5% rule to be a dynamic 5% rule for your retirement income. So expectation should be approximately $5,000 of income for every 100,000 you've got in your portfolios. This is the way you should be looking at your portfolios as you get closer to retirement. The worst thing you can do is what we provide for you, which is we give you a statement every month. If it were up to me, you'd get a statement once a year, and at the end of that statement, it would show you what kind of income to expect. You should pay no attention to short-term variations. In fact, you're going to be disappointed 30% of the time, because monthly, the variation's even more than annual. So if you can ignore the fact that if you look at your statement this month and it was 100,000, and last month it was 105, and you go, what are those guys doing over there? They're probably not even in the office. Remind yourself that the pension it will provide you, that 100,000, is approximately $5,000 a year. Put monthly, $400 a month. Every major pension plan, if you have one, you know that they'll send you a statement annually. Nowhere on the statement does it show you the asset allocation. Well, your money's being managed by portfolio managers like the pension plan. Okay, so why are you delving into that going, oh my goodness, I'm down 5? You should realize if you're down 5, that means what? That means the equity markets are down 10. I'd love the call that says, thank you very much for protecting my capital this month. But realistically, what you should do is go, I've got $100,000 in my portfolio. If I'm drawing out income, 5% rule, I should be able to take $400 a month, 5% of the 100,000. Now, base your 5% every year, if you want to give yourself a raise, on the year-end value. So in other words, every year in retirement, you can set that 5% instead of a stagnant based on what the 5% is. So if it's a bad year, okay, your portfolio drops to 90,000, now you only take out 4,500 that year. But if the portfolio jumps to 120,000, then you take out 6,000. So 5% of your year in capital. Great way to fire off an email to your advisor to say, look, is this a good year for me to increase my withdrawals or not? So then if you get subsequent good years, you can harvest some of those gains annually to keep up with inflation. The other thing to really focus on is to remind yourself, and we send you these things quite often digitally, but really understand your investment policy statement with your lead advisor that you've got with the team. That's what clarifies your objectives. That's what talks to you about how your money is being managed. It sets the maximum amount of equities that you can have. So on that investment policy, for example, on a balanced growth portfolio, it will say 55% equities. Now that means the target will be plus or minus 10%. So we can go up to 65% stocks or as low as 45. It should also identify, or you can identify and talk to your advisor about what's the maximum short-term loss you can expect. Very simply put, if you've got 60% stocks and the stock market drops 10%, expect you're going to go down at least 6% because you've got 60% allocation to equities. This is where we can clarify with you in your plan what your income requirements are. If you want to preserve your capital, generally what you would just take out is the income yield of the portfolio. So this would be a combination of the expected interest and dividends. So for every 100,000 we've got in our pension portfolio, the current yield's about 3%, which, if you recall, is very similar to the minimums that pensions will use for their minimum payout. That's approximately the income yield of a diversified portfolio, meaning that over time, the portfolio, you're just spending the interest and the dividends, you will get whatever the capital gains are. And in a balanced portfolio, about half the return is going to come from income and half is going to be growth. Okay? And obviously, number 4 is we rebalance regularly. During COVID, we did 3 times as much trading in 2020 as we normally do on an annual basis. So almost 35 trades for every $100,000 of assets. You have to have an active team like ours. These, advisors will say to their clients when things are bad, don't worry, just hold on, it'll get better. They should be doing something. So our team's very active. If the stock market's going down, we're buying. If it's going up a lot, we're generally selling. One of these people which is the lower right-hand corner, you probably know him, Warren Buffett. So one of the most successful investors of all time, classic accumulator, okay? So he's not a seller. He's the only thing he actually buys is businesses too. Same house, almost the same car. But where did he learn? So he learned from famous guys like Dodd, Graham, and Fisher. And these are the kings of the value investing style. In other words, the way to make money is to pay less for an asset and have it grow to its actual intrinsic value. Most people's problem and their worst enemy is themselves, and meaning they want to buy things that are expensive. And then when those things become less expensive, then they sell them. Why is there a loss there? Because you paid too much for it in the first place. This is really tricky when you're looking at valuing growth companies versus traditional kinds of companies. So you look at companies that have massive increases in their growth. This quite often takes an expert to find those companies for you. We hire third parties quite often for that. Value investing is more identifying companies that are intrinsically cheap based on fundamental analysis. So an idea there might be, buying a railway like Canadian National Railway versus a stock like Facebook or Amazon or Netflix or Google or Apple. We want to have both of those in the portfolio. Your biggest problem is seeing your portfolio go from 100 to 90 and then saying, now I want to be a conservative investor.